So I think now that we got that done, there's just one more thing that we want to consider, which is like, we can see that when the monthly price is above its moving average, that's about equivalent to the 21-day moving average being above the 200-day moving average in each of these periods. And we know the periods that we want to focus on because there were periods of prolonged interest rate inversion prior to that. And I guess, here's another head and shoulders going into 2025. So that's, with the declining volume and that late stage, here's 3 points that, the RSI is signaling, a potential good sell off. And, um, I hate to use price by itself without the interest rate. So there's one other indicator, which is called the volume. It's a volume momentum tool, and it can be pretty useful for spotting these bottoms. So if we're on the daily chart, it's a 21-day moving average and a 200-day moving average. This is where we sold off. This is another topic that's another separate topic for discussion, but we can see in April where the market followed through on engulfing on up volume, that is clearly an indicator that it is trying to go back up. And we can see that, we have inverse head and shoulders on the RSI, and then we have, the price eventually taking the moving average, and, way out in June, the two moving averages go back to normal. So, you have to look at, interest rates were inverted for a short time prior to this sell-off, and our rule is to basically get out of the market, when the death cross occurs, and stay out for as long as the rates were inverted and the death cross resumes. And so back around June, that is all true, and we're back in the market. And so, we get out of the market and then we get back into the market, but we can see that, possibly this bullish engulfing on the high up volume, um, you know, that is a clear signal that the market wants to go back up. And then what we have here is just an algorithm that's very, very similar to what's made out of these moving averages, and then applying the same to volume. And then, just looking at the momentum effect of volume and what excess momentum is captured by the moving average, and then doing the same with the volume weighted moving average, and then really looking at, where the momentum is starting to shift, which is evident in April of 2025. So if we're looking at this from an allocation perspective, we said we would start to drop allocation, leading up to a period of high financial concentration in the sector rotation and passing, the screens. And then we would, okay. And then, we would go down to maybe, 60-40 or 50-50 on death cross confirmation. And that we would then, basically stay 70-30 through here. But, if you're aware that you basically have all the conditions met for a recession rule, but no death cross here, but then it loses the 21-day average. That's your yellow light. I mean, this is a yellow light. And this is a further, continued yellow light while this becomes a red light. And what I would say is that this becomes your flashing green. And I would say at any point here, you can go back to 70-30. And then here is full on green. Which means that, basically any point throughout this V-shaped recovery, we would want to be 70-30. And the way I would do that is, maybe you want to apply this tool in April, or you want to apply the strong volume on the bullish engulfing. But any of these would be good indicators that you would want to do that. So why did we look at this? I'm not too sure. This is in 25. I actually thought we were in 2019. So we're going to ignore 22, and it's going to be about the same in 2019. So here we are, 70%, 30% yellow light. Here we are, 60-40 red light. And now we want to know when to get back in. That's what everybody wants to know. And price by itself, with the moving average, if we ignore everything below the volume, it's really hard to tell. Okay, but what is clear is that the price is selling off, it's retracing, it's selling off, and it's retracing. And that right there, we have an extrema here, that's a minima, and then we have a higher minima, and we have a maxima in between. And I want to call that a buy rule, and I want to go down to the RSI and notice that it is coiling up like a little triangle. And this is also, it looks like filament. That's also a buy signal. So when it starts to take the moving average down here, and it's trying on volume, you can use this V. And March of 06 is, it's making a V before you even have your red light. But I think that that's a good indicator that, it's trying to go back up, even though it's a failed V in March of 2020. Let's look at what happens a month later. Well, a month later, it's lower, but it's on the way back up. And let's look at a month after that. Well, it's lower still, but above the month before. So that's 2 months in. Let's look at a month after that. Well, now it's about where it was prior to that V, and back well on the way to being a normal uptrend, which is, where we want to resume back to full exposure. And I have to go back to that other graph because now the 2019, the interest rate period is done. 2020, the interest rate period is done. Here, we're not full green, although the market looks very healthy and normal. So you may want to just make an argument that, this whole recovery period wouldn't have been possible if it weren't for the rolling back of all the tariffs. And so if you're aware of that, and you're aware of that, each time the market gets to a scary point, we are making the right decisions for it to continue to go up. You may want to be 80-20, but actually, the interest rates were inverted for an entire year, which means that by the time we have our red light, we want to remain cautious for an entire year, which is we already talked about that. So you may want to just go back to um, 70-30 on resume of golden cross, but yield curve condition not met yet. Still prior inversion. So if we were to go back into another death cross soon, we would not meet the criteria to stay out of the market like we did in 2022 because we had prior interest rate inversion. So we would go back to a 60-40 if another death cross happened. Okay, so I think we're going to just see the same thing in 08 where we said August of 2007 is where our death cross signal triggered, or maybe it was out here in December, but well, there's a couple of V's. We have a V in January of 08, which pretty much just leads us right back to the 200-day moving average. And then we have another V followed by another V. Let's make sure these meet the condition for a V. So for it to be a V, we have to have this indicator have a real deep reading, and that reading needs to be below -4, which these meet that criteria. These V's look like they're just as deep, but they are not below -0.4. So they actually don't qualify as V's. This one almost does. We don't even have a V. And what's interesting is this indicator really, I don't know if it was even developed until like 2011. But we know that okay, we're cautious because of the financial concentration and utilities. And we have our death cross confirmation. And now I don't see anything really meeting the criteria for a V other than right here. Because it looks like a V. And I'm trying to think what we could do about that. I know we can see, there is some divergence, which is short-term leading the market to retrace. However, things are so strong to the downside, it's just so hard. But right here, we have this little period of like the RSI steps up. And then it basically rides along its middle line before it resumes the golden cross here. So we're basically 60-40, and at some point we want to start to slowly reallocate, which I believe would be in this period here. And we would slowly reallocate to 70-30. Um, we're just getting a lot of good upside volume. We're getting a lot of bullish divergence, and we've got this near V, although it's before that indicator was created. I think we can look to the past and know that that's how we want to handle that, and we can ignore the death cross that happened in between, which are typical drawbacks of the moving average system in that it whipsaws because there's no interest rate inversion here. So there's no reason to pay any attention to it. So we can see in 2018 we've got that death cross prior to COVID, and then in 22 we've got that death cross, but that's a lot of whipsawing, and it's just going to be so hard to follow. So I wouldn't pay it to any attention to it unless there's been prior inverted yield curve.